Making tax digital starts in 9 days, and 780,000 self-employed people and landlords across the UK are legally required to change how they report their income to HMRC. Most of them still haven't done a thing about it though, not because they don't care, and not because they're irresponsible. The messaging around making tax digital has been so buried in jargon that most people genuinely can't tell what's actually required of them. I'm Faz, a chartered accountant. I've read the legislation, and in this video I'm going to tell you exactly what HMRC needs from you, why the change is bigger than you've probably been told, and what happens if you miss it. The date is the 6th of April 2026. If your income from self-employment or property sits above £50,000, the clock has already started. The single biggest misconception I keep running into goes something like this. Making tax digital just means doing your tax return 4 times a year. That's not true. It's actually quite different, although it can feel like that if not understood fully. Most people have picked up the headline that MTD, making tax digital, adds more filing. Fine, that part's accurate. What almost nobody has grasped is everything else it adds on top of that. Your annual self-assessment return still exists, it still has to be filed, and MTD doesn't replace it. What MTD layers on top is 4 quarterly submissions, a mandatory software requirement, and a completely different way of keeping your records. Paper records no longer cut it, and spreadsheets alone no longer cut it. HMRC now requires your updated records to be held and submitted through MTD-compatible software, such as Xero, QuickBooks, Free Agent, or something similar. And here's the thing, that means HMRC will be watching your income in near real time, not once a year in January, when you've had 11 months to tidy everything up, but quarterly, while the year is still happening. Think about what that actually changes. Right now, a bad quarter, a slow month, an anomaly in your records doesn't really matter, as you have time to understand it before HMRC sees anything. Under MTD, HMRC sees the shape of your income as it develops. That is a structural shift in the relationship between self-employed people and the tax authority. And it's the part most people haven't understood. This isn't about filing more often. It's about HMRC having a live window into your finances. Let me walk you through exactly how this works, because the structure really does matter. I call this the 5 submission system. Before MTD, one obligation existed, one self-assessment return, due by the 31st of January each year. One deadline, one submission. Under Making Tax Digital, for income tax, that single submission becomes 5. 4 quarterly updates and 1 end-of-period statement. Submission 1 covers the 6th of April through the 5th of July, with a deadline of the 7th of August 2026. That's only a couple of months away. Submission 2 runs from the 6th of July to the 5th of October, deadline the 7th of November. Submission 3 covers the 6th of October through the 5th of January, deadline the 7th of February. Submission 4 carries you from the 6th of January to the 5th of April, deadline the 7th of May. And Submission 5, which is the final declaration that ties everything together, replacing the old year-end reconciliation and falling due by the 31st of January the following year. 5 submissions, 4 quarterly and 1 final, replacing what used to be a single annual event. Now here's what's critical about those quarterly submissions. They are not tax returns. You're not calculating your tax bill 4 times a year. You're submitting a summary of income and expenses for that period. And the final declaration is where the numbers get reconciled and your actual liability gets confirmed. But the quarterly deadlines still carry real consequences, and the penalty system doesn't give you much room. Most people assume there's a warning before a fine kicks in, which is a reasonable assumption to make, as that's how most penalty systems work. What most people don't know is that HMRC's model fires automatically from the first miss. Every missed deadline earns 1 point, and 4 points triggers a £200 fine, and after that, every further missed deadline costs another £200. No warning letter, no grace period beyond the stated deadline. 4 strikes and £200 leaves your account. It's automatic. Welcome to the new way of how HMRC are doing things. This is where the threshold question gets interesting, because there's a lot of confusion floating around about who's actually in scope. The qualifying income threshold for the 6th of April 2026 sits at £50,000. But here's the number that catches people off guard. Qualifying income means your gross income, before expenses, not your profit. Most landlords assume the threshold is calculated on what they keep. That's the natural assumption. And it's wrong. The calculation runs on what comes in, not what's left after costs. Here's why that matters in practice. 2 properties, bringing in £26,000 each in rent, puts your qualifying income at £52,000. And even if mortgage interest, letting agent fees, and maintenance costs pull your profit down to £15,000, you're still in scope. Gross in, not net. The same logic applies to sole traders. A freelance consultant billing £60,000 a year, with expenses pulling taxable profit down to £35,000, carries qualifying income of £60,000. In scope, no ifs, buts, or maybes. I call this the gross trap because the threshold sounds manageable right up until you run the actual numbers. Far more people hit it than the headline figure suggests, and that's not by accident. Look at the timeline ahead. The threshold drops to £30,000 in 2027, and again to £20,000 in 2028. If your income sits between £30,000 and £50,000, and you're watching this thinking, it doesn't touch you yet, just know it will, in 12 months. The time to prepare is now, not then. One more note, partnerships aren't included in this first phase. If you run a business with a partner, MTD for income tax doesn't yet apply to you. That changes, but not today. Let's look at an example. 2 people, same income, completely different outcomes. Let me show you how this plays out. Mo is a freelance web developer earning £55,000 gross per year. Self-employed since 2019, he knows the self-assessment system and has never missed a January deadline. His accountant pulls everything together in December. Mo signs off. It goes in before the 31st. Clean, consistent, reliable. Mo has heard about MTD, read a couple of headlines, and assumed his accountant will handle it when the time comes. No software, no registration, no change to how he works. He's carrying on as normal. Priya is also self-employed, also £55,000 gross, working as a freelance marketing consultant. Back in February, Priya watched a video about MTD and called her accountant the same week. She signed up for Free Agent, started using it in March, and by the 6th of April, her bookkeeping is already running through an MTD-compatible system. The 7th of August is in her calendar. She's ready. Fast forward to August 2026. Mo hasn't registered, and his old method, receipts in a folder, spreadsheet at year-end, is no longer compliant. He misses the first quarterly deadline. 1 penalty point. The second passes 2, now 2 points. His accountant still hasn't been called about MTD and isn't set up to submit quarterly on his behalf. By February 2027, Mo hits 4 points, £200 leaves his account, and he's still not compliant, which opens the door to further penalties. Priya has made all 4 quarterly submissions on time, the data flowing straight from Free Agent into HMRC's system, and her final declaration in January 2027 takes her accountant 45 minutes because the year's records are already clean and categorised. Same income, same sector, and the gap between them isn't luck, it's architecture. Mo kept one system and assumed it would still work. Priya built the system HMRC actually requires. The difference by January 2027 isn't just a £200 fine. It's the time, the stress, the scramble, the retrospective bookkeeping, the accountant fees to fixed records that were never kept digitally, and a penalty record with HMRC going into year 2. So here is what you need to do before the 6th of April. Not after before. Step 1. Check whether your qualifying income, gross and before expenses, clears £50,000. If it does, you're in scope now. Step 2. Register for MTD for income tax with HMRC directly. HMRC will not sign you up automatically, and they won't send a reminder. You do it yourself or you authorise your accountant to do it on your behalf. Step 3. Choose MTD-compatible software. Xero, QuickBooks, and Free Agent are the most widely used, most offer free trials, and your accountant may already have a preference worth asking about. My personal preference is Free Agent, if your books are simple. Step 4. Put the 5 deadlines in your calendar right now. 7th of August, 7th of November, 7th of February, 7th of May, 31st of January. The 5 submission system. 5 dates, and if you know them, you can't be caught out. Step 5. If you have an accountant, call them this week, not next month. Confirm they're set up for MTD, confirm they have the right software authorization, and confirm your engagement covers quarterly submissions and not just the annual return. Some accountants have updated their service packages for MTD, some haven't, and you need to know which camp yours falls into before the 6th of April. If this video has saved you from one missed deadline, one penalty point, or one frantic call to an accountant in August, share it with one person who needs to see it. A fellow freelancer, a landlord, or someone in your network who's been putting this off. The next video on this channel covers something worth knowing for anyone just crossing the 50,000 threshold and wondering whether it's worth restructuring to bring qualifying income below the limit. There's a legitimate strategy here, and there's also a trap, and I'll walk you through both. That video goes live soon, so subscribe to make sure you don't miss it, and I'll see you there.